So now, moreover, going forward, we have some amazing personalities joining us and throwing some light on private equity and venture capital investment outlook. May I please call on stage Mohit Gulati, Managing Partner and CIO, ITI Growth Opportunities Fund. Everyone! Then then replacing Pranavji, we have Deepak Mittal, Investment Director, Private Equity, Nuvama Asset and Management. Everyone, again. Then we have Tejesh over here, Senior Partner, IC Universal Legal Moderator. Without saying. And then we have Visalakshi over here, Managing Partner, Tata Capital Healthcare Fund, Tata Capital again. Zordar talia, everyone. I think the lady looks beautiful. All right, gentlemen and ladies, are we ready to start for the day? Can we go ahead? All right, audience, are we ready for this amazing presentation out there? Big one. Thank you so much. The stage is all yours.
Great. So good morning and thank you to all of you for being present here today. Warm welcome to all. And what I'm going to do is crystal gaze into the future of private equity and venture capital investing in India with the excellent set of panelists which I have got with me today for all of you. Before I deep dive into a barrage of questions which I have for all of them, let me lay down the context of what you can expect in next half an hour, right? We all agree we are in very interesting times today. There is a lot expected from the government and the regulators. We had the union budget less than a week back. There are a lot of hits and misses from the perspective of private equity and venture capital industry. And in the previous presentation, it was stated that the securities market regulator, SEBI, came out with a plethora of consultation papers, I think unprecedented for a regulator, that on a weekend, actually, on the Friday night, they came out with 5 consultation papers. And if quite a few of those proposals are going to get implemented, you will see changes in the way private equity and venture capital industry works in India. And that, of course, is on the top of a dozen plus sort of regulatory changes which have been notified in past year or two as far as SEBI is concerned. So yes, as I said, pretty interesting times, and the private equity and venture capital style of investing is going to determine a lot of things in next year or two, right? There are a lot of challenges ahead of us. There are a lot of stock market debacles which have happened. We are all aware what has happened to the unicorns, how the stock market prices have performed. And why do we only talk about the private market, right? We have all seen what's happening around in the last 5 or 6 days in the public market, wherein we are talking about one of the largest corporate groups in the world, and we are seeing what's happening to the stock prices out there. In the private market, a lot of challenges, a lot of allegations vis-a-vis the accounting frauds, the founders are being ousted, there are a lot of governance issues. So amidst all the euphoria we have got and optimism we have got, there is definitely a word of caution, right? So people will always say I'm cautiously optimistic on India, right? India has been shining, you can't avoid India, you can't take bet against India. There are quite a few questions which we have for them, and for next half an hour I can pretty much assure you will have a lot of valuable insights. So my very first question for you, Deepak, who is replacing Pranav today, and he is investment director with Nuvama. When we are talking about the funding winter, are the talks really there, and realistically, are you seeing that on ground today? And one insight which I need from you in last 1 year, have you seen the valuations becoming more realistic actually? Are the portfolio entities more conducive than what used to be till say a year and a half back? What are your insights or take on that?
Well, thank you so much. First, everyone can hear me? Good morning to everyone. Thank you so much for taking out time to hear us out. Sorry, Pranav couldn't be there, but he wanted to make sure that someone from Nuvama is present here, and that's where I sort of fill his spot. My insights may not be as good as that of Pranav. I'll try to sort of present the best views that I can. So to answer that question, is the funding winter is here? To answer that short answer is of course yes, right? I think all of us are experiencing it. But I think the way it's been, the connotation or the way it's been presented I think is completely not reasonable, right? I think what we saw in last 2 years was not the norm. What we're seeing right now is the norm, but the way it is being presented right now, that this is the funding winter and that was the the normal period, right? What we saw between April of 21 all the way to maybe even June of 22, 1.5 year period, that's not the norm, right? That's not what you should expect. This is what you should expect. You know, investing cannot be about excitement. You know, that's what you witnessed in that time, euphoria, positivity, excitement. And all of that is sort of needed to some level for any entrepreneurial sort of a setup. But as far as investing is concerned, it needs to be far more thoughtful. It has to be far more granular. It has to be far more data oriented. You know, we were looking at a number of transactions between, let's say, April of 21 and June of 22. And, you know, we were in a situation where there's no due diligence allowed. You know, there are a couple of investors who already come together and given a valuation figure, which in no kind of a metric ever makes sense. And the ask was that, you know, you're in or out, and you have to tell us within 4 weeks. Right? That's not the norm. Like, that cannot continue, right? So what we are seeing, yes, if you're coming, you know, down from a hill, you will see that we are somewhere in the plain right now. But what we should know is that this is the norm. This is what is expected. This is what will continue. This is what is more sustainable. This is where, you know, this is what will create a long-term sustainable value for investors and for the entrepreneurial ecosystem. So that would be my sort of response to.
Wonderful. Coming next to you, Visalakshi. One, do you really believe that reliance of alternative investment funds, particularly the private equity and venture capital, on the offshore funding has reduced to a good extent? Because there are a lot of domestic institutions which have come up, right? And I was in a ministry meeting a week back, actually, and the roadshows were being held for the insurance companies and for pension, actually. And we had even the likes of the foreign pension funds like CPPIBs and CDPQs of the world encouraging the Indian institutions that the kind of returns they have made abroad by investing into the Indian alternatives, actually, and they can take some cues from there. So the emergence of family offices in India and the likes of the Indian domestic DFIs, do you believe the over-reliance on offshore capital has reduced? And just to add to that query, yours is a sector-focused fund, right? You concentrate a lot on healthcare and life sciences. So what augurs for you in future, so to say?
Thanks, Tejesh, and thanks, Aditya, for having me here, and it's a pleasure to be here. So with respect to, from a fundraising perspective, and, you know, I think ours is I think I can take our fund as one of the, an example to talk through this. In terms of offshore investment versus a domestic investment pool. So we at Tata Capital Healthcare Fund, just middle of last year, we did a final close of our Fund 2. And we've had a mix of both offshore as well as domestic. Nearly 55% of our capital commitments came from the domestic commitments, and the balance 45 from offshore. So specifically on foreign capital, especially in the private space in India, I wouldn't say it's becoming less important. It's definitely more important, very, very important, especially the institutional foreign capital, the likes of DFI capital, the dedicated, you know, fund of funds, etc. So, and they are definitely very, very aligned with the Indian AIF industry in terms of the long-term needs of this this capital pool. But I think it's very, very noteworthy in the last 3 to 4 years. Yes, we have seen a good growth on the domestic capital pool, and let me maybe articulate it in terms of, you know, 3 or 4 buckets, and that's been our our experience as a fund in terms of further fundraising. Yes, I think the answer to your question is yes, there's definitely been more interest among the domestic capital pool, but it would be, I would say, the banks. We've you know, been successful in raising capital from some of the large banks in the country. Compared to, say, in our Fund 1 vintage to today, you know, today I would say all the banks in the country have a very dedicated process in terms of how to evaluate an AIF, how to conduct, how they are conducting investment committee meetings, and how they are, you know, actually responding back to the various queries. So there are proper investment professionals in the various banks, and I think that is a very big sign that this industry is going towards the right direction in terms of the I would say, the domestic capital pool. But a lot still needs to be done in terms of their allocation towards the alternative assets, because compared to the book size of the banks, right, alternative investments are still a very, very minuscule part. So even an inch up on that will actually release a lot of capital which is available for the AIF industry. Then the second pool, I would say, and this has been a big surprise for us, is the government-funded institutional pool. And there are seven, and this again is something which we have hit luck with. There are dedicated government pools of money for SME investing, for startups, for, I would say, certain specific sectors, and that, I think, is a very, very agile pool today compared to, and it was not existing 10 years back. So this is, and these are like several thousands of crores of capital that is there. And that is something which I think, we've been lucky to tap into, and going forward, I think subsequent AIF funds, etc., I think we'll see the benefit of this. And this is again a very dedicated alternative investing capital pool. The third, which has been talked also in the earlier session, is your, I would say, the corporate and the family office pool. This is something which is, I think they are very aligned today in terms of the long-term investing nature for the industry. But I would say that this corporate and the family office pool, they are very selective. So each family office or each corporate will have their own thematic in terms of whether they want to invest in real estate or in healthcare or in consumer or in tech, etc. And basis that, there is that capital pool which is going towards those particular AIFs. And finally, the retail section, which is the high net worth or the retail, which, and this is a class of investors who are actually, I would say, satisfying the minimum commitment requirement as per SEBI. So this class of investors, I think it's a pretty mixed bag, because, obviously there's a lot of education that needs to be done. And it's, I think, the AIFs will need to be, the fund managers will need to be conscious in terms of how they service this investor pool and cater to their requirements, especially when you have a mixed pool of investors, one which is a very, very long-term oriented, another is, some of these high net worths, etc., may not have a 7 to 10 year kind of an horizon, unlike, say, a large institutional pool. So I think the trend is definitely there. We will see, we'll continue to see good growth in terms of domestic capital pool. There are good pockets of money that one can tap into, and it's very, very encouraging to see. Coming to your next query regarding us as sector-focused fund, yes, clearly, I think the time has come. I think we've seen the age has come in terms of having dedicated sector-focused fund. For us, as a fund, we focus on healthcare and life sciences as a sector. Given the fact that healthcare, life sciences as an investing philosophy is among the top 5 in terms of, or 5 sectors for attracting private capital investment. So clearly, yes, there were dedicated real estate investment pools, and similarly, consumer and tech focused. I think, you will continue to see, we are seeing, I don't think we've seen several of them coming about. I think, what we used to see 10 years back, you pretty much had similar number, probably less than half a dozen or maybe closer to 7 or 8 dedicated such sector pools that are there for each of those sectors. But going forward, as the, as the pool of capital increases, definitely I think this will continue to be the order of the day.
Absolutely. So there are merits with specialization, of course. And just to go back on the previous answer which you gave, just to throw some numbers, when we were talking to the government and when the pension officials and IDA officials were there, they estimated a 2 lakh crore of money which is investable from these pension funds and insurance alone into the alternatives, basis the limits which are available right now. And if you really see the numbers, what they have invested is not even a small fraction of that. And if you compare that with the more mature markets like US, the share of alternatives is on a massive rise. We are not even a 10th or maybe a 20th of what they are actually investing. So just to say, if there is an unlock of domestic capital actually, Of course, the foreign capital brings in that kind of a discipline, right? But yes, we do have a lot of domestic pools of capital also available with us. So let me get to you, Mohit. ITI is a sector agnostic fund. So we have talked about a sector focused one. You are sector agnostic. So one insight what we would love to have from you is, what are the 3 top sectors you believe from a venture capital perspective? And I'm not talking about a very long-term horizon. Let's talk about a year down the line. What are the top 3 where you would be putting your money in, and why?
No, absolutely. Thanks, Tejesh. Typically I'm very controversial on these panel discussions, so urging you all to not record. I'll just give you a very quick one-liner in terms of why the sector agnostic strategy, because I think every family office we go to, they ask us the same question. And I think fundamentally my thought is that venture capital is an industry where you're basically a team of dreamers who are trying to dream into the future and see what's going to be hot or what's going to be in action in the next 2 to 3 years. And by virtue of that, and by virtue of working in a country like India, that keeps changing. Like D2C as a sector 2 years ago was the hottest thing. Everyone wanted to invest in direct-to-consumer companies. Today, when you look at the numbers, barely 2 or 3 brands have actually even been able to reach EBITDA level positivity, leave aside PAT level. Nobody wants to touch a D2C product. So what we very consciously decided was to go the sector agnostic route, to be dreamers, to look at things ahead into the future. And even since you asked me a question for the next 12 to 18 months, I mean, look at the whole AI wars that have begun, right? I mean, ChatGPT is just the starting. There is so much that can be done. AI as a service, right? There's basically the last 15, 20 years on Web 2, what you've been doing is only giving out your data. But the internet's not really made sense out of who you are and what you do. The Web 3 basically puts it all on a central blockchain, can add layers of AI and NLP on top of it, and make a lot more sense of the data, give you a lot of contextual search in what you want. I mean, I can almost tell you for a fact, I know so many people who are completely removing copywriting teams from their organizations because ChatGPT is doing a better job. So I think the AI wars is definitely something that is very interesting for the next 15 to 20 odd months. The Web3 architecture, I think, is very interesting. It's like completely reimagining how the internet was ever used. 5G has, of course, those of you who've started your 5G services on your phone will realize when you have over 600 Mbps of speed, and I can see most of you would have started off your internet journey with the DSL networks, where you had a modem which would go ting and all of that. Today, 600 Mbps of speed on your phone. It's limitless possibilities what you can do. Augmented reality. We're talking about cars being innovated on the metaverse first, and then 3D printed directly onto the ground. So I think there is a lot that's happening on a constant basis. From our fund perspective, we are supremely bullish on 2 sectors, which is the electric mobility EV side. We have the largest charging network company in our portfolio, and they're also the largest software manufacturer for EV. But we didn't make this investment today. We made it in 2018. That time, not even Gadkariji was talking about electric mobility. The fact that we were able to catch the trend 4 years ago and then build out India's largest in that space, or do something in the drone space, where we took a call that Zomato delivering you food via drone, you won't die if your food comes 30 minutes later. But medical application of drones, right? If I'm moving organs, critical organs, moving blood samples from point A to point B, that is life-saving. The government will be a lot more receptive to using drones for that space versus letting e-commerce and food delivery happen via it. So it's important to not only predict what sectors you want to be invested in, but also see where do you as a country, where does India stand in those sectors? 2 years ago, everyone was wanting to invest in neobanks. We took a call that the fundamental proposition of neobanks is flawed. If you're trying to build a layer which competes with existing banks and is trying to do a buy now, pay later and con people from 24 to 48% rate of interest, it's not something ethically, fundamentally we felt is survivable. And RBI came and clamped it completely. So that's, I think, the reason why we keep the sector agnostic strategy, and hopefully Fund 2, Fund 3 will also be on the same lines.
Great, wonderful insights for a lot of us looking to do angel investing, right? You're talking about drones, you're talking about EV. Definitely the sectors for the future. Coming to you, Deepak, it brings me to the question on the ESG side, right? There's a lot of focus on environmental, social governance norms today. How critical are they from your perspective when you invest into the portfolio entities, right? We are seeing so many talks, and I think it's not about the private market or public market, right? There's so many allegations on the accounting frauds, for example, the founders who are being ousted. There are a lot of negative news around it. So how critical the governance become for you from, say, a Nuvama's perspective when you are going to invest into a portfolio entity? And have things changed over the last couple of years, or is it more focused now, or has it always been the case for you?
So I would say this: if there's one single thing that keeps up at night, it's about the governance in the companies that we're evaluating and our own portfolio assets, right? In terms of, we are absolutely crystal clear that we want to invest and partner with entrepreneurs, with companies that have the highest level of governance standards, and how can we work with them to continuously improve on that. And I would say that, so until maybe about 4 years back, the kind of companies that we as a PE fund, were largely investing were companies which were 15-year-old, which had time to build their, finance function, build their investor relations functions, build their MIS reporting and all those functions, and which worked really well. But what we've seen, a number of these tech unicorn sort of companies which have come up in the last 4 years, at a stage where we are now looking to invest in them, I would say a lot of those companies haven't had an opportunity or even focus to invest a real effort in that direction. I think a lot of those companies are focusing more about growth, more about, I would say, fear of missing out on a particular growth opportunity, and that sense, and they have not really, invested as much as we would like them to invest regarding something very simple, as simple as MIS, monthly reporting, data visibility, and things like those, right? And I would say, if there's one ask that I would have from the entire investment community, is that we need to be very, very thoughtful about this. I think it is, returns can come and go. They could be low, they could be high. So the way I kind of think about it, I could lose money in many different ways. It's possible, right? We're gonna, but this is not the way we want to lose money, right? Like if of all ways in which you can potentially think about, losing your capital, having a governance issue in a portfolio company is probably the worst way of doing it, right? So I would say this is extremely important. I think this is one of those things that's not talked about. I think this is also a symptom of what we saw in the last 2.5 years, where people were not asking these kind of questions, at least from the new age sort of assets as much. But I'm very, I would say, hopeful that these things are coming to light now, and I think once these things come to light, people become more and more careful and thoughtful about the way these things needs to be addressed. And I see a lot of change that are happening in our own portfolio assets. I see a lot of conversations happening in that direction when we now talk to the target investee companies. And I would say it's a step in the right direction, but there's a lot more that can be done in that sense, yes.
And just to add to Deepak's point, right, I think, and I don't want to solely blame them, but I think a lot of foreign venture capital and PE capital has to be blamed for this, right? Because this blanket sort of sweep under the carpet strategies that they've used, because in bull markets, nobody cares. We've looked at a few transactions, which we looked at Go Mechanic 3 weeks ago. The founder was in our office. And he's saying that, the reason I did it is because I had my largest investor telling me that go ahead, show more GMV numbers so that SoftBank can come in and do $1 billion valuation for you. So, which I think domestic funds, and particularly domestic GP-backed funds, are a lot more conscious about, because A, we are answerable to pools of capital which are residing in India, people who understand India a lot better than people who don't stay here and don't understand India as well. And I think it has to, that cleanup has to start from all fronts, but definitely from the ones, and which is what I think this finance bill has also done, right? Where in the budget, you're sort of now creating segmentation between the capital pools, domestic AIF versus foreign funds. Try building out those two buckets differently, have different sets of rules, which are applicable to both sides, and those who are taking board representation on a particular company need to showcase liability towards that.
I think governance is the buzzword. You can't ignore governance at any cost, right? It will be a very costly mistake, right? And the fund managers are out there to raise capital for their future funds also, right? And with the transparency you have with the LPs today, you are really required to report them on the real-time basis, actually. You can't afford to make a governance mistake. So I totally agree with you. Out of like 100 ways of losing money, this is the last on your list actually to lose money that way, right? That brings me to you, Visalakshi, on the LP-GP relationship, right? Very, very, very sensitive topic, so to say that. But have you seen sort of a shift in this relationship over a period of time? Are you seeing more sort of negotiations Or in future, can you see that there is a pressure on the way GPs charge the carry or the management fee? And are there expectations on, say, the reportings which really have to happen more frequently on the health of your portfolio entities? So from a transparency perspective, are the expectations more from LPs, both from domestic and offshore side of it? Where are you seeing this going for the future funds and the present one?
So first of all, I would say an LP-GP relationship is something which needs to be nurtured. Otherwise, I think you have to be comfortable in, as a GP to think in the shoes of an LP. And it's a very, very long term, for multiple funds. And we know for sure that an LP, especially an institutional LP who comes into fund one, or, very rarely do institutional LPs come into fund one, but they come into fund two or fund three, but they can, commit to you and they can back you as a GP right up to fund 7, 10, whatever, right? So I think that's the spirit with which one approaches an LP-GP relationship. Now, coming to some of these sensitive points, I think, yes, definitely there will be, certain preferred terms, etc. Maybe, let me try and give color in terms of, what areas does an LP look at, maybe certain specific terms or maybe commercials, etc. See, there were two aspects to the commercials, right? Obviously, one is the fee and the setup costs and the carry, etc. I would say that's, and any anchor investor who comes, or any of the large institutional investors with a certain, above a threshold of a ticket size, definitely there will be certain preferred terms, but I think that's something that's the least of the negotiations, because I think even a GP understands that an LP is coming in and filling in at the time of the first close, right? Because, only if you get to your first close, then only you will get to your other multiple closes and then achieve your fund close in, within the shortest period of time. But more importantly are some of those, the other aspects, and each LP has their own set. Like, for example, if it's an impact investor as an we have one offshore investor who's an impact investor, and they have, certain impact targets, and they believe that healthcare is a sector where you can actually have impact targets. And so we, as a fund, have committed to job creation as one. On every $1 million invested, we said we will create so many X number of jobs, incremental jobs, or we will create a double-digit growth in the beneficiaries. And that is something which is new for us in Fund 2 compared to Fund 1, right? So, and this is, while this initially sort of drew from an LP, but we think as an idea, this is a great concept to sort of embrace and take that forward. On the other hand, there would be obviously some of those terms which will differ. Like, for example, few of the LPs will want to sit on your advisory board. They will want to, have terms relating to fund extensions, relating to conflict resolution, relating to governance for that matter, right? Tightening governance framework, etc. Especially areas around key man clauses, etc. So some of these things are very aspects, but I think once you get going past that, I think it's a nurturing of a relationship for a lifetime, right? And not just through that one fund, but through multiple funds. That's the way one should look at it as an LP-GP relationship.
Can't agree more. And having worked with dozens of funds actually and fund managers who had raised the institutional capital for the first time, and ESG always appeared to be a cost for them, right? There's a long schedule which will be annexed to your LPA, your contribution agreement, and they thought they need to have an ESG officer. There are LPECs. They were not used to this kind of sort of a methodology in the past. But come the next fund, when these similar institutional LPs are participating, they really see the value, right? And ESG is not a cost end of the day. There are so many analyses which are out there in media and in public which clearly suggest that the outcome of ESG exercise, it will increase your returns in the long run. So it is not a cost. It may appear to be a cost in short run, but there are real benefits which are optically visible in the subsequent funds. So absolutely bang on. Mohit, one last question for you. We have seen a lot of regulatory changes in the past, right? I also talked about 5 consultation papers being floated by the regulator. Do you believe that there are some knee-jerk reactions, the regulatory regime which started with light touch sort of a framework, has it become a little more reactive that way? So is it continuing to be practical for GPs, or you are seeing a lot of pain areas on which regulators would need to work on? What's your take on that?
No, I think, this is always a controversial question, right? I think regulators try to do whatever it can do best in terms of protecting investor interest. That's like the mother subset from the regulator perspective, whether it is retail investors, whether it is large family offices or even institutional investors, regulators clearly on their side versus our side. And we accept that. We humbly sort of, work around that. Are the compliances, are the measures across reporting extremely difficult? Of course they are. But somewhere I think, the more you try to resist them, the worse it gets. I mean, for the first 2 years, I was constantly at loggerheads with, my back-end team and saying, why are we doing this? Why are we doing a monthly reporting? Why are we doing a quarterly reporting? There are these long sheets that we are filling. And now, our systems and processes are so much in check that it doesn't make a difference now. So, things are streamlined. And we're a very small fund. My sense is for a larger fund, you'll require that level of checks and balances today. From a GP perspective, since I co-own my GP with ITI, I think very few GP partners have actually taken home large pools of capital in this country. Let's first address that elephant in the room. Okay, so the fact that on an EBIT level, okay, and I'm saying EBIT because you may have mark-to-market gains on your fund, but net of costs, net of distribution, net of actual money, capital returned back, net of hurdle rates met, how much money have GPs in India made? It's a very, very small number. But regulators are thinking that, oh my God, these guys are making a lot of money. Let's go and find frameworks in taxing them. Let's find frameworks. So I think somewhere the regulator's gone a little ahead of the market. It's gone ahead of, us really even making that kind of money. But I think every year this will keep changing. So by the time you come to your fund life, see what the regulation at that time is and make hay when the sun is shining, or in some cases, the sun will not shine and you will not make hay.
Interesting. Okay, so why don't I do a quick rapid fire with each one of you. I may have 4 questions actually and will pose to each one of you. So I start with you, Visalakshi. For you, which is the biggest hit and flop in the union budget, what we had last Wednesday, from your perspective?
I think, especially on this industry, this entire single window clearance, right, for the gift city, where with respect to, I think it's a single window clearance for RBI, IRDAI, SEBI, GST, whatever you call it, right? I think has been a big hit. Obviously, the VCP industry was looking for parity on the tax, right? So that was something which we, there was no mention about that, and that's long overdue. So.
No, so I think she stole my answers, but
Yeah, both are answers.
yeah, those are the best answers. But okay, now let me go to the next best answers. So I think, so there was a lot of positive news or announcements around Gift City, right? And I think the most important one was the single window clearance. But other than that, I think there's a lot of positive steps in that direction. From what I understand is that there's certain more clarity or availability of funds from foreign banks for acquisition financing. That's being made available through this Gift City framework. I think that's also quite good for, for the entire ecosystem, not just for a PE, VC, but across businesses. I think that's quite good. Then I think there's an incentive for the foreign funds to relocate from the outside offshore location, Singapore or Mauritius or some of this, to come to the Gift City. I think there's certain
tax holiday continues. Yeah.
An encouragement in that direction. I think that's a positive. I think that will sort of encourage that will grow the domestic industry in a certain fashion. So I would say some of those are positive. I would say the big flop is, as she said, I think there's a lot of, I would say, lack of clarity or parity between listed securities, unlisted securities, whether it is debt or equity, whether it is foreign investors or domestic investors. I think there needs to be a lot more clarity in terms of what needs to be considered capital gain, what needs to be considered business income, and I think that I think there's a lot more that can be done in that direction. Yeah.
Right.
Tejesh, I mean, after both of these, there's hardly anything to add. But I'm a more glasses half full guy versus a glasses half empty. So I'm just glad that they didn't increase the LTCG to 25%. So sometimes no news is good news. That is one thing. And second is, I think broadly, as long as they sort of stay true to the course, the practice any which way is going to grow. When you make money, you pay tax. That's the norm of this country now. So I think a lot of us need to focus on making money versus waiting for the government to help us make money. And we'll make money by doing good investments. We are in the business of money management. You can write books, and there are people who've written books and raised a lot of money, but not really given returns. Or you can just keep quiet and make money. So that really is, I think, the key crux of things.
Well, less controversial answer. Nobody talked about the angel tax, right? That's going to impact. Past many years, you have been talking about no tax parity, no tax pass-through for category 3. I think every budget, pre-budget, we have those talks, but nothing happens. No inheritance tax. That may be one good one, but thanks for the answers. And my next one is one book, actually. It may be a web series, it may be a movie, which best explains the private equity and venture capital industry for you. Rizal.
I'll go a little more philosophical. Very inspired by the book, How Do You Measure Your Life? Clayton Christensen. I think ultimately in life, it's, there are life metrics. In the private equity industry, it's returns, right? So,
Please note down the suggestions, actually, if you have not read that one. It's a good suggestion for the weekend. Yeah, please.
Yeah, I'm not really sure, but if I have to pick one, so the famous one would have been seen by all, or I will go a little bit offbeat, but so I would say the movie Moneyball, I think it's a very interesting one. It's not exactly about the fund management business, but I think it, in certain kind of a mannerism, it presents the kind of way we should act as a fund manager. We need to kind of look at the world from a different perspective, right? That's the only way to create value for our investors. If you look at the exact same data or analyze the same things or just do the way everybody else is doing business, then we're not going to be able to create advantage for our investors. We're not going to get the value for our buck. I think the Moneyball, in some ways, shows how can you think, different from the crowd, how can you get more out of the little, and how can you create a portfolio of assets, if you will, where the whole is, significantly more than the sum of the parts. So I would sort of encourage you to see Moneyball in that, with that perspective.
So Deepak sort of taken up, so I had a book in mind, I had a movie in mind, but I also have a backup book, so I'm going to tell you both. Okay. The movie is The Big Short. I think it's possibly the best definition of investing across every asset class, right? For every buyer, there has to be a seller. If everyone's a buyer, and in the last session we spoke about 21, 22. My LinkedIn was so controversial because I was the only one shouting at the top of a mountain saying that guys don't subscribe to Zomato, don't subscribe to Paytm. Tejesh, you and I exchanged notes on it. And nobody wanted to listen to it. So I think The Big Short is a great lesson, and what's happening to the largest corporate in the country today, right, is what goes up can always come down. There's nothing called too big to fail. So I think it brings sanity. You have to have both sides of the market. And second is the autobiography of Agassi called Open. It's a very beautiful book. Those of you who've read it will, of course, relate to it. But those who haven't, I urge you. You may not really enjoy waking up every morning and doing what you do, which could be fund accounting, fund management, or whatever it is. But stay at it for whatever greater course of life, and you may achieve so much in it, even despite hating what you do. So people talk about, I love what I do, but sometimes you just need to hate what you do and you still do well in it. So that's one book.
Very interesting, and I can't resist but quoting The Big Short, right? And for all those who have not seen it, should see it actually. And there are a lot of scenes actually which showcases how difficult the life of a fund manager is. If you take risk, there is an issue. If you don't take risk, there is a return issue, right? And when Mike Burry, who's the main central character and played by Christian Bale, actually, and when he is in office and investors are walking in and asking, where is my money, why NAVs are down by 20-30%, they get to know that swaps have been there, mortgage bonds have been short, which means that if every US citizen is going to fail in paying their or repaying their housing loans, then only the fund manager is going to make money. And they're abusing him left, right, and center. And sometime down the line, when he says that, okay, 500% plus returns have been generated and he's closing the fund, but very sadly, he says that, okay, last 1 year, whoever he knew and he respected only spoke to him in last 1 year through the lawyers and said to the regulators. So this is how tough the life of a fund manager is. That way. Okay. That brings me to the next question. Which other profession you would have been in Visalakshi, if not the fund manager? Maybe everybody would love to know. 1 minute.
So,
This is
profession.
the last one.
Well, I would be an instrumental musician, actually.
Superb.
Yeah. Yeah, I have no talent for music. Yeah, so I think I would like to be a sports person, maybe a squash player or a tennis player, something like that.
Yeah, I would like to be a journalist, and I do most of that on LinkedIn, so catch me.
Okay, all right. So we are done with the session. Actually, if Aditya permits, we may have a question or two from the audience. But thank you so much. A round of applause for the panelists here for providing insights. Please, Arvind. We can take one, or you give us liberty, or we are
Thank
crunched
you
for
so
time.
much, everyone, for joining
I
us
think-
on the
I think-
stage
I think it's
and making
really-
the most of it.
I think we'll give one question.
Well, first of all,
right.
congratulations to all of the outstanding speakers for their great insights. Thoroughly enjoyed it, and of course, Tejesh, your comments were also so nice.
Thank you.
I could ask a lot of questions, but I'll just direct my question to Mohit. Mohit, you made some very interesting comments, and one of them was that you had already invested way back in 2018 into things like electric mobility, batteries, etc. Would you be kind enough to dwell a little bit more on that thought? And how do you really make money in electric, mobility and batteries? Not every investment is a success. How do you select a good quality, electric mobility or battery investment?
So I can do a 1-hour session on this, but keeping it really short, don't invest in a vertical, invest in a horizontal. So don't try going behind one. In China, there are 4,600 registered 2- and 3-wheeler manufacturers. The same is going to happen to India. Look up Jitendra EV in Nasik. He does a 200 crore top line, just selling EVs in a 300 kilometer square radius. The reason why Bajaj and Hero will not be the leaders in two-wheeler is because you will see disruption, length and breadth of the country. Manufacturing an EV is a very easy task. Any one of us in this room can do it. What you can't manufacture is software. I provide the largest software layer to all the EVs in the country today. Whether you're Ather, whether you're Ola, whether you're Okinawa, I'm the largest software, I'm the largest charging network. All plugged in together, showing up on your speedometer, which is the human to machine interaction. That was our call. Can we play it as a horizontal versus going down into a vertical? So happy to exchange more thoughts on it, but that's the core thesis around it.
That was a nice one. That was a nice one. Thank you so much, all over to the ladies and gentlemen. Now, may I please call on stage for felicitation Udit Surekha from Nuvama Asset Management. Everyone on the round, please. And a small token of appreciation to all the outstanding speakers out there. Where now we all know some books and some movies to refer. Right? All right. Ma'am, a picture, please. Thank you. Thank you so much, everyone, for joining on the stage. Thank you.